How does leverage change the risk-reward ratio? Have you ever wondered how leverage can impact your trading experience? Let's break it down in a straightforward way. When you use leverage in stock trading and options, you can control a larger position with a smaller amount of capital. This means that both your potential gains and potential losses can be much larger than if you were trading the underlying asset directly. Think about it this way. When you buy an option contract that controls 100 shares of stock, you are putting down much less money than if you were to buy those shares outright. If the stock price moves in your favor, the percentage return on your invested capital can be significantly higher. For example, if you invest $100 in an option and the stock price rises, your return can be much greater than if you had invested $2,000 in the stock itself. However, this increased potential for reward comes with a catch. If the stock moves against your position, your losses can also be magnified. In options trading, the maximum loss is limited to the premium you paid for the option. This means you could lose all the money you invested in that option. But if you are trading stocks on margin, your losses could exceed your initial investment, which adds even more risk. So, how does this change the risk-reward ratio? Leverage allows you to control a position with less capital, which increases the ratio of potential reward to the amount of capital at risk. While you might be looking at higher potential returns, the risk of losing your entire investment, or even more in margin trading, also increases. This is why managing risk is so important. Traders often use strategies like stop-loss orders, position sizing, and diversification to manage risk effectively. In options trading, leverage is often expressed as a ratio. You can calculate this by dividing the total value of the underlying stock position by the cost of the option premium. For instance, if you control $10,000 worth of stock with a $200 option premium, you have a 50-to-1 leverage ratio. This shows how much exposure you have compared to the capital you invested. As the stock price fluctuates, the leverage can change as well. If the price moves favorably, the effective leverage on your option position can increase, amplifying your gains even more. On the flip side, if the price moves unfavorably, the leverage decreases as the option loses value. In practical terms, leverage allows you to use your capital more efficiently, potentially increasing your returns. But it also requires careful risk management, because the amplified risk can lead to rapid losses if the market turns against you. Understanding how leverage affects the risk-reward ratio is essential for traders looking to navigate options and margin trading strategically. Balancing the desire for higher returns with the need to control potential losses is key to successful trading.